Hey everyone, and welcome back to IvanVentures Podcast. I'm your host, Ivan, here with my fantastic co-host, Mella, and our silent partner, Miklo the cat, who is currently chilling in the studio.
He's our chief morale officer.
Exactly. And if you hear a little meow in the background, that's just him offering his unsolicited commentary on interest rates.
And trust me, Miklo has very strong feelings about the cost of cat food these days. Inflation is hitting the feline community hard, Ivan.
I can imagine. Well, that's actually a perfect segue because today's episode is a big one. We're diving deep into the Federal Reserve. You know, the Fed, it's America's central bank, and we'll break down what it is, what it does, how it impacts your money, and why billionaire investor Ray Dalio thinks the Fed is heading into one of the toughest spots in modern history.
This sounds heavy, but important.
Super important. Let's get into it.
Okay, so Ivan, let's start at square one. What exactly is the Federal Reserve? I feel like I hear about it all the time, especially with headlines about the Fed raising rates. But if someone asked me to explain it, I'd probably just, stumble.
You're not alone. Believe me, it's a great starting point. So, picture this. It's the early 1900s. The US financial system is like the Wild West. There's no central control. This led to a series of huge banking crises. So, in 1913, Congress created the Federal Reserve to basically be the adult in the room to stabilize everything. Think of it as the referee of the economy, making sure money keeps flowing and banks don't, collapse. And that brings us to fun fact number one. The Fed was literally created because of something called the Panic of 1907. This was an actual financial meltdown where people lost faith in the banks. They all rushed to withdraw their cash at the same time, and some banks just didn't have it. They went under. The panic was so bad that it basically scared Congress into finally creating a central bank to prevent that from happening again.
Wow, so it was literally born out of pure chaos. It's not just some boring government building, it has a dramatic origin story.
Totally. A superhero origin story almost. And its structure is, well, it's a little weird, but it makes sense. You have the Board of Governors in Washington, D.C. That's 7 people who serve these really long 14-year terms to keep them independent from politics.
14 years? That's longer than a Supreme Court justice, sometimes.
Yeah, it's a huge deal. Then you have the FOMC, the Federal Open Market Committee. That's 12 members who are the ones who actually vote to set interest rates. And then spread across the US, you have 12 regional reserve banks. They're like the local branches, keeping an eye on their part of the country's economy, which leads me to fun fact number 2. And this is one of my favorites. Grab a dollar bill, any dollar bill. See that little letter and number code on the side like B2 or K11? That letter tells you which of those 12 reserve banks originally issued that bill. B is for New York, K is for Dallas, F is for Atlanta.
No way! I'm looking at a dollar right now. It says L. What's L?
L is San Francisco. See? It's all connected.
Mind blown. Okay, listeners, pause the episode and check your cash. This is amazing.
So now we know where it came from, but what does the Fed do all day? It really has 5 main jobs. It sets monetary policy, that's the big one. It supervises other banks. It maintains financial stability. It manages the country's payment systems, and it protects consumers. But its single biggest influence, the tool everyone watches, is its ability to set interest rates.
Right, and that's the part that hits us at home. The interest rate they set, it ripples out and affects everything. Mortgages, car loans, credit card rates, student loans, even the interest your savings account earns.
Every single one. And to manage all this, the Fed holds a staggering amount of assets. Which brings us to fun fact number 3. Did you know the Fed currently owns over $7 trillion in assets? For perspective, that's more than the combined market value of Apple, Microsoft, and Google.
Wait, what? 7 trillion? What does that even mean? And how do they own that much stuff?
It's mostly government bonds and mortgage-backed securities. And this is how they use their power. It's a process called open market operations. When the Fed wants to stimulate the economy, it buys these bonds, which pumps more money into the financial system. It's like pressing the gas pedal.
And when they want to slow it down,
They sell those bonds, which pulls money out of the system. That's hitting the brakes. It's this constant adjustment, this balancing act to keep the economy from overheating or stalling out. And that phrase, balancing act, is key because that's exactly where our main story comes in. Ray Dalio, the legendary investor and founder of Bridgewater Associates, has been warning that in 2025, the Fed is going to be walking a razor's edge. He calls it a very difficult balancing act between controlling inflation and preventing a recession.
Dalio, he's the big debt cycle guy, right? His stuff is fascinating, but also a little terrifying.
That's the one. His whole theory, to simplify it, is that economies and empires rise and fall in predictable patterns or cycles that are driven by the buildup of debt. Eventually, the debt becomes too large to be paid back, and you get a major correction or a restructuring.
Like a reset.
Exactly. And his big warning is that he believes the US is in the late, most dangerous stage of that long-term debt cycle right now.
And just so everyone knows who we're talking about, here's fun fact number 4. Dalio's hedge fund, Bridgewater, is the largest in the world. It manages around $150 billion. So when he speaks, especially about debt and the economy, people on Wall Street, they drop everything and listen.
So based on his theory, Dalio is flagging several major red flags. He lays out 4 big red flags. The first is what he calls the yield curve warning. In simple terms, if long-term interest rates start rising while the US dollar falls and the price of gold goes up, that's a classic sign that global investors are losing faith in the ability of the US to pay its debts.
Okay, so that's like an external report card, and we'd be getting a failing grade.
Pretty much. Red flag 2 is debt costs. He calls rising interest payments plaque in the arteries of the economy. It just slowly squeezes the life out of government spending and private spending because more and more money has to go just to servicing the debt.
Red flag 3 is deficits. The US government is spending way more than it takes in. Dalio says we need to cut the deficit to a sustainable level, around 3% of our total economy. But with the current political gridlock, nobody thinks that's going to happen.
Yeah, that seems optimistic. And the last one, number 4, is the scariest. He calls it the debt death spiral. This is when rising interest costs on the national debt force the government to borrow even more money just to make its interest payments. That new borrowing pushes rates even higher, and you see the spiral. It's like quicksand.
And didn't he also have a warning specifically about what could happen if the Fed tries to intervene? I remember reading that he said if the economy weakens and the Fed has to cut rates, they would also have to launch a massive intervention to buy up all the new government debt. He called that a, quote, very significant bad event. Basically, it would be a huge global signal that the US financial system is in real trouble.
That's exactly right. It would be a last resort. And speaking of last resorts, that brings us to fun fact number 5. This isn't theoretical. The Fed has been pushed to the brink before. Back in the 1970s and early 80s, the US had runaway inflation, way worse than what we've seen recently. To crush it, the Fed chair at the time, Paul Volcker, had to raise interest rates to nearly 20%.
20%? I just can't wrap my head around that. A 20% mortgage rate, a 25% credit card bill, that would destroy people's finances.
It did. It caused a massive recession, but it worked. It broke the back of inflation. Dalio's point is that the Fed might face a similar impossible choice again. So, after all that, why should you, listening at home or in your car, care about any of this? Because it touches every part of your financial life.
It's not just for Wall Street traders.
Not at all. First, as we said, interest rates affect what you pay on every loan you have. When the Fed hikes rates, your next car loan is more expensive. Your mortgage payment is higher. Your credit card debt becomes a bigger burden. And third, it's about debt management. Dalio's warnings about the national debt are a mirror for our own households. How we manage our own debt determines our financial health and our ability to weather these economic storms.
So the Fed's decisions really do show up at the grocery store, at the gas pump, and in our bank accounts. It's about whether your savings are actually growing or just losing value to inflation.
Perfectly said. And that brings us to our final fact, fun fact number 6. There's a famous saying on Wall Street, don't fight the Fed. It simply means that whatever direction the Fed is pushing the markets, whether they're hitting the gas or the brakes, it's incredibly difficult and risky to bet against them. They usually win.
So you have to play on their field.
Exactly. And Dalio's warning is really a call to action for us as individuals. Even if we can't control the $34 trillion national debt, we can control our own. Pay attention to your finances, get your own debt under control, and make smart, diversified investments for the long term.
Wow. So we've gone from the financial panics of 1913 to dollar bill secrets to Ray Dalio's big debt cycle. It's clear the Fed has been at the center of America's financial story for over a century.
Yep. And right now, it's facing one of its toughest chapters yet. But remember, knowledge is power. The more you understand how this giant system works, the better you can protect yourself and even find opportunities in the chaos.
Well said. And on a lighter note, Miklo would like to add that he's still waiting for a federal stimulus package for cat treats.
We'll have to table that motion for the next FOMC meeting. All right, everyone, that's our show. Thanks for tuning in to IvanVentures Podcast. If you enjoyed today's episode, please hit that follow button, share it with a friend, and remember, financial knowledge today is financial freedom tomorrow. We'll see you next time